Hello, this is Jim Ammerman, Managing Director of Wealth Planning at Fortress Wealth Management. And in this lesson, we're going to discuss how your federal taxes work and some helpful definitions for you. So in this chart, I have pulled up, notice on the x-axis, the horizontal axis, we have taxable income. And that is going to be your adjusted gross income less itemized or standard deduction and qualified business income reductions, if that applies. On the y-axis, the vertical axis, we have federal tax bracket rates. So as you have more taxable income, the federal tax bracket rate gets higher and higher. You can think of it like this. Think of these brackets as buckets. So in January, you're filling up the 10% bucket with your income. February and March, maybe you're filling up this 12% bracket, and so on. In this example, with the yellow shaded area, if that was the total taxable income for somebody for the year, so this would be about $50,000 for a couple or $25,000 for an individual single filer. The marginal tax rate is going to be the tax increase on the next dollar of income. In this example, the next dollar would be also at 12%. So that's the preliminary marginal tax rate. The true marginal tax rate, however, includes the effect of some levers that can change your marginal tax rate. So Social Security benefits, the way those are taxed, it's phased in as your income increases. So that can make your real taxable marginal tax rate possibly 23%, or maybe even 27% in the future if this bracket goes up to 15%. Capital gains, you also have another phasing. That can make your true marginal tax rate as high as 55%. You have, Medicare premiums. Those premiums go up the more income you have. There's the Medicare surtax, the net investment income tax, QBI deduction. All those things can make your true marginal rate higher than just what the bracket rate is. I've got another video that's titled "How Your True Future Marginal Tax Rate Can Be Much Higher Than the Bracket," if you want to see an example on that. And then for the last definition, we have effective tax rate. So that's the blended rate. That's the total tax divided by the total taxable income. And an example, if we look at the yellow shaded area here for this individual, he's got about equal amounts of taxable income being taxed at 10% and also at 12%. So the average of those two is 11%, and that's the effective tax rate for this person. Or I should say this couple. These arrows indicate the cutoff point, which determines when you go to the next higher bracket. So for a couple, it's 19,900 here, and then it's half that for a single filer. Then you have different amounts here as you go up. The filing single amount is always going to be half the joint amount, except at the very top bracket where it is significantly more than half the joint number. We also might have that amount lowered in the future. They were talking about that earlier in 2021. By the way, these are all 2021 numbers. That fell off Biden's bill, but we'll see if that comes back in the future. And a fun fact, most of these rates are scheduled to go up in 2026. The Tax Cuts and Jobs Act will expire at that point in 2025. And so these rates are all scheduled to go up for the most part. If you have any questions, or if you would like a free assessment on your particular situation, feel free to send me an email, jim@fortress-wealth.com, and thank you for your time.